Hello there, Investorholics, my subscribers. Welcome to all those who may be checking out these presentations for the first time. This is ETF Spotlight Review, and today we'll be checking out REIT, which is the VanEck Vectors FTSE International Property ETF. This one's hedged. If you're interested in diversifying your income through ETFs, this is a good one to have a look at. As we just sort of mentioned, this is an international focused property ETF. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances. Expand your investment horizons and crack your financial sky. So let's have a quick look at this one. So REIT gives investors access to a diversified portfolio of international property securities from developed markets, excluding Australia, with returns hedged to the Australian dollar. REIT aims to provide investment returns before fees and other costs, which tracks performance of the index. Why are we looking at? So the ETF gives the investor geographical diversification, property exposure, income and growth potential, currency hedge portfolio. You're also going to get access to subsectors not found in Australia, such as hotels, resorts, healthcare REITs, and specialised REITs, including self-storage and data warehouses. Some of those sectors are covered in Australia now, so you've got like the likes of self-storage with you look at national storage and data warehouses or data centers. Maybe have a look at like Next DC and things like that. We had a net asset value of $16.56, trading below that for what it's worth at $16.45, market cap of $38.7 million, management cost of 0.43%, it's not too bad, it's not the highest, it's not the lowest either. You get some money in your pocket quarterly, January, April, July, October. Dividend yields around the 5% mark. So property allows many fortunes to be made by developers and investors globally. Many of these people have built their empires by investing in real estate beyond Australian shores, I should say. Listed real estate investment trusts enable small investors like me, like you guys, to access property without having to invest the huge sums that would be required for direct purchases or direct investment in big projects. Investing for income requires that you build a portfolio that includes different but stable types of asset classes, which are globally diversified in a way for reducing investment risk. REITs may be a good option to achieve diversification. So a key benefit for REITs is a defensive income stream they provide. Property assets typically earn reliable income from rent, which provides a regular income stream to investors. Even during economic downturns, right now we may be seeing something a bit different just due to COVID-19 and how that's pretty much shut everything down. So we're just got to sort of keep an eye on how these REITs really react, and more so the underlying assets, I should say anyway. Additionally, rents can be linked to inflation typically. That means income increases at the cost of living, so that's good for the investor. REITs can provide consistent portfolio income and could be a good income option for the long-term buyers or investors. Different alternatives, we can look at rent. DJRE or SLF, but SLF is Australian focused, so maybe have a look at the other two. DJRE is probably where I'd start initially anyway. So look at some performance here. Obviously the graph looks quite brutal given the fall off the cliff due to all the close downs for COVID-19. You're sort of starting to see a bit of a tick up anyway as confidence comes back in the market. So on the right hand side you've got the list of the top 10 holdings, predominantly US holdings, but you can see there's Mitsubishi Estate, which is Japanese, but predominantly you're looking at an American income stream effectively. So despite the persistence of volatility in the markets and continuing uncertainty around COVID-19, the defensive attributes of REITs could help them stand out over the long term. But we've just got to keep an eye on the impact on the office sector, and that'll vary country to country depending on the length of the average lease periods and how long the lockdowns continue. Social distancing is also a problem within the property sector, and it's been having a big effect, mainly to the thanks to the decline in the retail foot traffic, and that also affects hotels and office vacancies. So duration of the virus is definitely uncertain, and that makes the future uncertain. There are many areas in the REITs in general where things can turn out to be better than in the GFC. So there's some downside and some potential upside to keep an eye on. If you're looking at for a long-term investment, I think this one is definitely one to look at, and like we sort of already touched on, diversifying your income. So if you're looking for generating income, you definitely want to have different streams and different coming from different areas, I should say, if I can get my words out. I definitely wanted to have a look at. If you're an income investor and you're looking at trying to generate some stable income, so you kind of know what's happening from month to month, this is definitely one to have a look at. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. Because KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.